You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Global Investments. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, Swan Defined Risk Mutual Funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody, welcome back to Options Insider Radio Network and indeed to the Advisor's Option program, the program here on the old network where we help you, the busy financial advisor, the busy asset manager who maybe doesn't have time to pay attention to this space or perhaps to learn about options, but you want to know more, you want to do more for your clients in the options world. Well, don't worry. We've got you covered with education, analysis, breaking news from the world of options that pertains to you, all sorts of fun stuff here on the Advisor's Option. My name is Mark Longo from the aforementioned Options Insider Radio Network, as well, of course, from theoptionsinsider.com. If you like the show, a lot of great articles over there on the website for you guys to sink your teeth into as well. And of course, however you listen, maybe you listen via the website, maybe you listen via iTunes, via our mobile app, however you get the show, make sure you hit us up, questions, comments, insights. We do like to hear from you guys. What are you seeing in the space? What are your needs? What are your questions? We'd like to hear from you guys. We get a lot of questions. We try to make sure we rotate as many as we can onto the show. Don't have always that much time on the program for questions, but we make sure we answer them all, even if we don't have time to read them on the air. And of course, remember, we do like to hear from you guys. And joining me on the program today, let's start off, let's go in order of north to south. So starting off, we're going to go tale of two climes, starting off with the frozen north of New Hampshire, where we are joined by good old Matt Amberson, the principal over there at ORATS, Options Research and Technology Services. Mr. Matt, welcome back to the Advisor's Option.
Thanks, Mark. The market goes up and the temperatures go down.
Certainly seems like that, doesn't it?
Yeah, we're digging out from a snowstorm, but we could work a lot more if we can't get outside the door. So it has its good points.
There you go. That's a good outlook for it. It keeps you prisoner, so it makes sure that you can actually just be a slave to the grindstone and just work 24/7. And now I said we have a tale of two climes. Let's go down a little bit farther south to maybe a little bit different weather environment, down to scenic and sunny Puerto Rico, where we are joined by Chris Hausman, the portfolio and chief technical strategist over there at Swan Global Investments. Mr. Hausman, welcome back to the show. Happy New Year. Actually, Happy New Year to both of you. It's our first show of 2018. And how are things in lovely and scenic Puerto Rico, sir?
Very good, and I'm glad to be back, and Happy New Year to yourself. Matt's right. The market keeps going up, but the temperature is always sunny and 85 degrees here in Puerto Rico.
The market keeps going up unless it's something crypto. Then it's not exactly the best week for all things crypto. Don't worry. Maybe we'll touch on that a little bit later. We're going to kick things off with our Tricks of the Trade segment.
And now it's time for practical tips on how to implement options into your practice. It's time to learn the tricks of the trade.
All right, everybody, welcome to the Tricks of the Trade, the portion of the program where we tell you some tricks and some techniques and some strategies for how we like to implement options here on the old Advisor's Option. You know, one of the most prominent use cases out there for advisors, one of the things most of our listeners are spending their time doing, is they're managing their clients' retirement assets. That's where the lion's share of their interest and activity, and of course the client's interest and activity is focused. And we're always talking about different things you can do with options, different strategies and things. The question we get a lot, and it's actually something we've addressed before on the show, but it's been quite a while, and so I think it's worth discussing and doing a little bit more of a deeper dive this time, is essentially the question we get from you guys a lot is, A, can I use options in my clients' retirement accounts? And B, then the subsequent question, the follow-up question we always get then is, okay, how should I do that? So we're going to dive into that today on our Tricks of the Trade. Let's answer that first question straight off right away. Can you use options in a retirement account? The answer is yes. So you can wipe the sweat off your brow. You don't have to worry about that. The downside, if there is one, is that you're a little bit limited. You can't go hog wild as you could in a regular trading account, let's say blasting away at naked puts or selling naked calls or things like that. Basically, anything naked is going to be out. Anything that really requires a margin component is going to be out. Now, that said, you can do some interesting strategies, and we'll get to all of this. Let's do some basics first just to make sure, because you can do most of the things you probably want to do in a retirement account. So the basic strategy people like to have, people come to an advisor, they say, you know, I'm long a bunch of stock. That's certainly a question I'm sure a lot of advisors are getting right now. Sitting on some gains, isn't everybody these days? What can I do as an option in my using options in my retirement account? Can I indeed hedge those gains using options? And you'll be happy to know, yes, you can. You can come out and buy options. Trade up buying strategies, you can utilize all of those in a IRA or retirement account. As long as you're outlaying for that strategy and there's no crazy third leg that's short naked 3 or something like that. As long as you're outright buying, let's say, a spread, or you're outright buying an option and it's 1-to-1, then you're okay. So buying calls, buying puts, those basic strategies, all copacetic when it comes to retirement accounts. And then, of course, moving on to some other topics. So maybe before I even keep going, I know you guys probably have a lot to weigh in on this as well. I could spend a while listing my strategies, but let's have you guys chime in with some of your thoughts. Maybe some of your most popular use cases you've seen for options in a retirement account. Maybe Matt, we'll start with you, because I'm sure you get this type of comment and question a lot over there at ORATS. Hey, A, what can I do in some sort of retirement account? And then B, specifically for you guys, because this is what you do, is, what is the most effective approach of these limited set of strategies I can utilize in my retirement account? So Matt, what are your thoughts on those areas?
Yeah, I like the IRA because there's the taxes are deferred. What you need to keep in mind is these option strategies need to be risk defined, like you said, no hanging short legs or cash secured. So you can actually sell puts if you have the cash there and you have the right type of broker that has that allowed in the trading account. You can't sell short stock, but there are some tricks that we could do, like using an ETF that has short exposure or ultra short exposure. You can use those, and then for the short strategies for options, you try to find their covered counterparts. For example, if we've tested a really good short strangle, you might want to convert that to an iron condor by buying the little calls and puts outside of the short calls and puts that you have, or a short call, you might make a call spread. So those are a couple of the things that we think about. It's hard to say what works best. Obviously in these markets lately, the selling of the of volatility has worked best, obviously, but we even test things in 2008, 2007, and there are some short strategies that you can, if you're nimble enough, and exit at correct times. We've been testing some really interesting strategies, so that's what I see on those, Mark.
That is a good point about adding, the wings to those types of those typical strategies, like you mentioned, the short strangle, they would be off limits. But you're right. If you make it just risk defined, so you have the short leg, then you come in behind it and you buy a long strangle to hedge it and protect it. You're going to spend a little bit of what your premium you're collecting to do that, of course. But the flip side is now you can utilize it in a retirement account. It just becomes a different strategy. Very similar. It's just, like Matt alluded to, it's just an iron condor for this example, instead of just a naked short strangle. And he also mentioned, of course, which is an important point, that you can indeed write puts to get into a long equity position in an underlying. Just a little bit different scenario. You have to do a cash secured put, which effectively means you have to set aside the amount of cash you're going to, let's say you're going to buy the stock. It's going to cost you $1,000 to buy the stock. Instead, you write the put. You have to set aside that $1,000 or have it ready to go, free in your capital, in your account, in order to do that short put trade. You can't just naked sell the put and then not have enough capital in there and deal with margin calls and everything. So the rules of the game, rules of engagement, a little bit different when it comes to retirement accounts. Chris, maybe a similar question for you. Obviously, you guys are always out and about doing, the 10th box and educating advisors on these topics. And of course, what you guys do with your overlay as well. I'm sure you get this question a lot from different asset managers and advisors out there. So what are your thoughts on options utilization in IRAs? And maybe like Matt, maybe do you have any thoughts, any interesting tweaks for what people can do to make their options trading more profitable, more exciting, what have you, in using an IRA?
Yeah, absolutely. I think option trading in IRAs is a lot more versatile than what most people think. One of the best examples is the defined risk strategy, what we manage here at Swan. We're able to implement this strategy in IRAs and take advantage of a lot of these different strategies that you've mentioned here for our defined risk strategy again. So for me, personally, I use IRAs almost as a petri dish or a place of experimentation because, the whole thing about an IRA is this is a long-term investment. I can kind of set aside a little bit of capital here to play around with different types of strategies. And it comes down to knowing your synthetics. So Matt hit it right on the head. If you know your synthetics very well, you can construct all these different types of strategies that maybe a traditional outright you would not be able to get away with in that IRA. But if you can kind of tweak it, know your synthetics, and trade different options or ETFs or different underlying or what have you, you can pretty much do just about anything in an IRA.
yeah, there is this perception that is limited, and there are some limitations. But as you mentioned, there are some ways to get around it. But a lot of the basic strategies that advisors and the clients want to utilize, I mentioned already, you can naked come out and just buy a call, buy a put. You can do that. You of course can buy spreads as well, as long as they're 1-to-1. So it's a buy one call, sell another out of the money call, that sort of thing. You can do that. If it's 1-by-3 or something like that, you can have a little bit. You can't do that in an IRA. It gets back to those naked legs you're talking about before. Cash secured puts, obviously very popular. The holy grail for the advisor and the asset manager market, which is of course the collar, which is having a long stock position, buying a protective put, selling a covered call. So a combination of those two other type of strategies we just outlined. You can do that as well in a retirement account. So that probably covers 90% of the strategies most advisors utilize out there. There are a few others that we like to recommend or at least discuss. So interesting use cases for IRAs that we found to be pretty effective and just advantageous for a lot of people out there. For example, a lot of people have stock in their IRA. It's a very common use case. Very interesting thing you could do using your IRA, and again, using options is a very simple strategy. It's the old stock replacement strategy. So someone's sitting on a stock position, they want to own it for some time. They don't have no interest in selling it maybe anytime soon. You come in and you could just quite simply swap out the stock for, obviously you have a near-term taxable event, but aside from that, if the outlook is the same, you can swap out the stock for a long-term leap. Usually that's a long-term equity anticipation security, usually a year or longer. And usually they're typically in the money when you're buying these, because you want to have somewhere of the approximate delta of the stock. You don't want quite to get a 1 or a 100 delta. That could be very expensive. But usually for these types of strategies, anywhere from 60 to a 75 delta is typically what people do. So you're going a year, 2 years out buying a 60 to 75 delta option, and that gives you a lot of the bang of that buck and a lot of that position of having the underlying, but it has a lot of benefits. First off, it's going to be much more capital efficient in terms of, instead of swapping out the stock, now you just have to buy an option. That's usually a much cheaper, much more capital efficient process. And B, you have all the Greeks working for you. So if the underlying appreciates, which is what you want to happen, that delta is going to increase. You're going to make more money as the stock goes up until you get pretty much 1-to-1 with the stock. On the downside, which is the worst case scenario for owning that position, of course, the Greeks are also going to work for you. That delta will decrease, so you'll lose money at a slower rate than if you own the stock. And also the volatility will work for you. It should kick in, also help you lose money at a slower rate than owning the stock. So that's one very straightforward, very simple use case for IRAs. A lot of people overlook. And then, of course, if you want to get a little bit fancier, a little bit more active, you can start doing some interesting things like turning those into a long-term, what some people term synthetic covered call, some people will term a fig leaf, and this will depend, I think, on the sophistication of your broker too. If they see these positions as one spread, or if you may have to do something else, you may have to have the stock leg in order to let them write the covered call. So that would be something you have to check with your broker on, because every broker kind of views this a little bit differently. But effectively, now you can write a near-term covered call, usually, let's say a monthly, maybe a weekly, if you want to get very advantageous and really take advantage of that theta. And now you're collecting theta on the short leg, and you have the long leg of the long leg of the option to off that. So effectively, you've done a diagonal spread. Now, again, some brokers are going to maybe look at that and say, okay, you're naked on the call, so you can't do that. So that's probably something you want to check with your broker ahead of time. Some are a little bit more savvy with options than others. But if they are willing to allow that, then now all of a sudden you have the stock replacement, all the benefits we've mentioned there, and now you also have the income component of effectively what is a covered call. So those are two areas that are usually very interesting and very simple to do in an IRA. And of course, as well as our old friend, the collar, which is kind of just, like I mentioned before, the holy grail for many advisors out there, and something you can clearly and easily do in pretty much any retirement account out there. I don't know, any last thoughts? Maybe Matt, we'll start with you, going back around the horn. Just some thoughts, some ideas, some tips, anything you want to have, because obviously retirement accounts are where the lion's share of our audience are doing their options trading. So any thoughts, any ideas you have, you want to leave them with on this topic before we keep on rolling?
Yeah, when you were talking, so your tax is different in your IRA since it's deferred. So, there are some market behaviors out there, i.e. the implied dividends that if you're a sophisticated investor that you might be able to take advantage of by having this kind of different taxable rate. And yeah, and the other part is if you're like me, I don't look at my IRA that much. So I like to have longer term collar type things in there, or a call spread collar. So if it blows through it, I don't really need to worry about it too much. So that's the way I look at the IRA, Mark.
Yeah, it tends to be longer term stuff. I'm trying to think. You probably, I think in a lot of brokers, you probably would have to turn if you wanted to do like a long term stock replacement and then have, let's say, that a covered call kicker. You probably have to turn maybe that short call into some sort of vertical, something like that, just to appease your broker. We'll have to get a check in with a lot of brokers and see exactly how they would rule on that sort of thing. But Mr. Chris, same question for you. Obviously, IRAs are where a lot of the action is when it comes to options and advisors. Anything you want to leave our audience with on this topic?
Yeah, I just want everyone to be prepared about lifting up that fig leaf and making sure you know exactly what's underneath it. I agree with you that 60 to 75 delta area is the sweet spot if you want to do stock replacement going into the longer term options. But remember, we're going to be taking on a lot of vega risk, right? That volatility risk. So that's just an added component that people need to understand, that if you did leave stock on, you wouldn't have to deal with that. So I do think stock replacement is a tremendous tool for people to use, but you also have to understand all the risks that come with that as well.
Yeah, there are bonuses to having those Greeks working for you. There also can be some downsides. So if you're not familiar with those, then certainly perhaps a refresher on the Greeks, which we've done several times on this program. Just check the archives for yourself, and it should put you in good stead going forward. Speaking of going forward, it's time for us to check out what was the big news in the world of options that pertains to you, the busy financial advisor. Yes, it's time to get the buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, everybody, time to get the buzz, a portion of the show. We break down what were the big stories in the world of options since the last time we all gathered around the old advisors option panel. Let's start, like I mentioned, this is our first show of 2018, so it's always good to start maybe looking back a little bit. And, there was a theme throughout most of 2017. In fact, Matt, you and I discussed this back at the big options industry conference back, I believe that was in May of last year. The theme throughout most of, at least the early half of 2017, was a lot of concern, quite frankly, in the world of options. We were in an environment that was kind of unprecedented. We had the VIX just, I think effectively, you could call it charitably anemic, non-existent. Pick your adjective, and it usually applies there in terms of how low the VIX got and for a sustained period. Usually that's a recipe for a pretty dire turn for the options market. Usually you need a little bit of volatility, a little bit of juice to really get things going out there. On top of that, we're coming off a year where the options market was already lower the year before, and people were coming into that year with very dire outlooks for 2017 already. And then when you have this added layer, this added component, this added headwind of an extremely low volatility environment, it seemed like it was just a 1-2 knockout punch for the options market. And a lot of people were really concerned that there really wasn't, it's going to be a terrible year for options, all things considered. Well, we have the numbers now. They are in, and we can definitively look back and say, actually, 2017, as weird, as outlier of a year as it was, actually turned out to be pretty good for the options market, which is a crazy sentence to say. If you had told me at the beginning of the year we're going to have this environment where volatility is going to be non-existent for the entirety of 2017, and you had asked me then to predict what the year would look like for options, I would have said, of course. I think most sane people would have said, of course, it's going to be a terrible year for options. And it actually turned out to be pretty good. The numbers are in from our friends over there at OCC, which is, of course, the parent company, the parent owner there of our friends at OIC, who are part of this program. Of course, in their numbers, OCC stands for the Options Clearing Corporation. So they take the other side of all of your options trades. So they should know how well things did, or perhaps how poorly things did in 2017. And last year was actually a pretty good year, about a 4% uptick from 2016. So about 4.17 billion contracts cleared. Actually, I'm sorry, that was the 2016 numbers, 4.32 billion contracts in 2017. So a 4% increase. Again, that's overall for OCC. They clear a lot of stuff over there. So let's dig down into those numbers and drill into them a little bit. With exchange-listed options, that's, of course, where we like to play and hang our hat. Exchange-listed options volume up 3% in 2017, so nearly 4.2, about 4.19 billion contracts overall. And ADV for actually, that's for December, was 16.7 million contracts. That was up 4%. Overall options volume for the month was also pretty strong. These are December numbers in here, but they lumped a lot of things in with this report. But effectively, the moral of the story is that overall, it was a surprisingly robust year for options, which I don't think any of us pretty much would have predicted. I don't know, Matt, Chris, we talked a lot. Matt, you and I discussed this specifically 6 months ago or so, and it did not seem at the time, even then in May, it did not seem like 2017 was going to be a very strong year for all things options. And, surprise, surprise, VIX kept trending lower, and yet volume kept ticking up. Even VIX options set a number of records, and VIX futures last year, which another thing, if you had told us at the start of the year, I think all of us would have called you crazy. So, I don't know, are you as surprised as I am, Matt? Or maybe you guys see the tea leaves over there at ORATS a lot in the daily volume and things. Maybe did you see this coming and this didn't come as a surprise to you?
Well, the option market loves a bullish underlying market, so that always helps. And a lot of this selling a premium, a lot of the big boys are in there. The realized volatility, and we talked about this last year, and we were talking about how low the VIX was, but what we pointed out was that even though the VIX, let's just say 10 or 11, the realized volatility is down at 6. So there's still a large spread between what stocks are actually moving and where the implied volatility is, and that represents a profit opportunity for a lot of these folks. I also think that it's interesting that we have a lot of pension funds, and I've been looking at those a lot more closely. Their assumptions drive how much money people need to put in, and if they're underfunded, they're going to have more money in more funds in the in the stock market. But what we're seeing that they're doing is protecting those, so they're invested in the stock market so they could have their future growth assumptions higher, but they're also using options to protect that money in the stock market. So I actually think that's partially what's fueling the stock market. Is a lot of these funds are somewhat underfunded, and it's kind of a catch-22. They need to put more into risky assets like the stock market in order to have their assumptions of future growth up at a certain point. So that's how I look at it, Mark.
Yeah, just one other comment. I think that the increase in volume is a testament to education out there, and shows like this that help advisors learn and get more comfortable to using options as return enhancers in portfolios and also hedging out risks. So again, more and more advisors are incorporating options in their portfolio, and that's probably one of the reasons, or it's absolutely one of the reasons why volume increases. And then just to kind of reiterate what Matt said, just because volatility is low on an absolute basis, option trading or option management is all about managing relative relationships. It's not about absolutes. And I think when people get into this business, they get so stuck. I mean, we hear every single time that the VIX is at long-term average is a 20 and it's a mean reverting product. Well, it's not a mean reverting product. What it is, it's a product that trades in different regimes. And the trick is to figure out when you are in between those regimes, because once upon a time, and both of you guys know this, you would be begging to buy a VIX at a 20, right, during your floor careers. Now it's like, are we ever going to see it again? I mean, who knows? So again, be careful with falling in love with absolute levels of volatility. You have to learn how to manage relative levels of volatility. And the trick is really, when is volatility going to shift into another regime? The regime that we are in, obviously, is in a low absolute, but yet I still consider it one of the higher relative volatility periods. So harvesting premium was still profitable this year. A lot of people were asking, well, how on earth can you harvest premium or continue to make income? Well, again, it's managing the relationships between, like Matt said, realized and implied. So again, the trick is, and I'm not saying there aren't risks to this, because there's always risks to everything that we do here, but the trick is really realizing when you're jumping from regime to regime.
Yes, the VIX is a regime-heavy instrument, and I think 2017 is kind of its own interesting regime. And speaking of, we talked about a good year for options and what a good year, the polar opposite, the other side of the coin to options, which is typically usually a more active style of strategy, is kind of the passive. And that's been a big trend in recent years in the market as well. And a lot of that is represented by ETF volume. And I'm heading down to the big ETF conference next week, so I thought it'd be interesting to check out some of the numbers for 2017 on the ETF front as well. And a lot of people put out these reports. This one came from ETFGI, their research and consultant firm on the ETF front, as you might imagine. They did their study and analytics for 2017. Overall investments, ETFs, and ETPs listed in the U.S., so this is just specific to the U.S., increasing by nearly 35% in 2017, reaching a new high, $3.42 trillion by the end of last year. The assets invested in U.S. ETFs or ETPs grew by a record $874 billion over the year. That's over double the previous record of $419 billion set the year before. So year after year, this trend of heading into a lot of passive ETFs is growing. The increase is $2.5 trillion. It was $2.5 trillion at the end of 2016, up 34% now to the end of 2017, when it closed again at $3.42 trillion. Also represents the greatest growth of assets in that space since 2009, when, of course, coming off the heels of the big financial debacle in 2008. Also interesting to note, I didn't realize this, as it was this year, or actually coming up next week, probably why they had the big conference next week, perhaps, is it's the 25th anniversary of SPY. Pretty much, I think the ETF a lot of people think of. When they think of the ETF space, they probably first jump to SPY and some of its big index brethren there. SPY by itself accounting for about 271 of that, what did we say, $874 billion. So a good chunk going into that SPY, which is pretty much into that passive camp of tracking the index. And of course, it worked out pretty well last year. ETFs love a bull market more than options, perhaps, but it worked out pretty well. So interesting stuff. There's a lot of data here. I don't want to get into all of this. There's some surprising big names on that list as well in terms of top ETPs by new assets, things like daily 3x long natural gas from Velocity Shares ETP doing pretty well in terms of assets there. So a lot of VXX, of course, a very popular one. So there's this ETF space has grown and evolved. It's not all just, of course, passive indexes. There are some things, trade volatility, trading nat gas and other things, obviously, but still it does represent a lot of this passive flow. Just an interesting point to raise up, of course, as we're talking about options volume. There still is flow in this passive space. Doesn't mean it's all options, of course, options agnostic. A lot of people trading SPY, of course, trade the options as well. So there's a lot of action, VXX, of course, and other names like that. But it still is interesting to note the correlation. Matt, interesting subject, kind of the opposite, the dark side of the coin for us here in the options world. We like to see a more active investing community. People have been moving passive, and these numbers kind of reflect that, but also some interesting nuggets in there as well. What are your thoughts on 2017 being a surprise, was also a good year for ETFs and ETPs, Matt?
Well, I think that the ETF and ETP community has done a good job at listening to their constituents and listening to the market. They're able to get out there and make all these different sorts of ETFs that meet the needs of the investing population. We talked about IRAs and even that ability to use an ETF to be short or ultra short. I have a little story. My mom is 80 in California, texted me today, "What do you think of BLOK?" And I almost fell out of my chair. So block is the new blockchain. I think it started yesterday. The blockchain ETF. There's also BLCN, and they're not allowed to have blockchain in their name. The SEC disallowed that, but what they're doing is they're identifying companies that have, and they actually, like BLCN actually scores companies on how much they either use blockchain or accept blockchain, and are part of communities, and they have this whole scoring system. So it's kind of interesting, but I think that kind of shows how the ETF community is on the pulse of the market, Mark.
Yeah, I have a question about, and this can be for both of you guys. I mean, do you think there's too many copycat type ETF, ETP products? And Matt, for you, from the back testing front, do you get a lot of requests to do back testing with these ETFs and ETPs, like pairs trading or all that kind of thing? I know you're mostly option centric, but I mean, do back tests come in to try to arb out any type of relationships between all these different ETFs and ETPs that exist?
Yeah, I mean, a lot of these, it seems like a lot of noise. Some don't trade at all. But we've actually helped some of these bigger ETF makers backtest some of the strategies that they're going to put into the ETFs, and the more responsible ETF parties that are putting these ETFs together, they're working hard to make a good product and not just a fly by night. But yeah, I mean, you get some of these copycat ones that are not well thought out, and then they end up falling on their face, and then it kind of just takes our time because there's no option market, nothing's trading on it, and so you can't really have a valid back test because you don't know where to assume you're going to get filled on the options, and we don't do that, just the underlying off of each other, Chris. But yeah, that's how I'd talk about those copycats. Mark.
Yeah, I think the first part of your question, the copycat, I think we passed that bridge a long time ago. There's every permutation, every flavor of assets and strategy therein you could think of has already had some sort of ETP created for it, and usually multiple flavors. I mean, I think the VIX space is probably the best example. Just so many different ways you can carve up the VIX beast. Usually a lot of them don't perform that well, just because the product itself is kind of screwy how it's set up. But still, if you look there, almost every viewpoint you could want to express in terms of volatility is represented by some ETP. Again, how they actually perform a little bit different than how they might perhaps market themselves, but at least in terms of how they want to do it, there's every viewpoint. I mean, look at the fact that we had in this and just the strange niches that are exploding. I mean, liquefied natural gas ETPs jumping into, this is 3X, this is a levered 3X long natural gas. The ticker is UGAZ. Was number 2 on the top 10 ETPs by net new assets in 2017, right behind the iShares Gold Trust. So, you never know what's going to strike the fancy of people. And now I'm sure now that one has taken off, we'll see legions of copycats in this space. So, yeah, I'm constantly amazed by A, the variety in this space, and B, the lack of any sort of shame in this space when it comes to, hey, this ETF, this ETP is working. We're going to blatantly copy that for our own purposes. So yeah, I don't think we have crested that yet. I think we still have a lot more in terms of copycats to go. Any last points on this before we move on, Matt?
Yeah, I just did a quick thing while we were sitting here. I downloaded something off of our API where I looked at call and put volume times the stock price times the month to at the money implied volatility. So I just wanted to get a picture of really where the volume is in the market right now, and not just volume, but if you're using implied volatility and stock price, you're kind of getting a picture of how much premium's traded. Just really back of the envelope, but really, and this is going to come no surprise to Chris, but the SPX is just far and away on that measurement where most of the premium is trading. It's almost 4 times higher than the rest, SPY and such. So, we have to pause to pay homage to the old guard there at the SPX, Mark.
Yeah, in terms of actual value being traded, kind of hard to hold a candle to the the progenitor out there, the SPX. Speaking of other big topics in the world of pretty much all of the world of finance, but also now in our little corner of the world, getting into the derivative space. Since our last show, we are all pretty much living in a post-Bitcoin futures world. We saw the first product launching on the 10th of December, and then the second product, that was the SIBO contract, which was approximately 1 coin contract. Then we saw a little bit bigger contract coming a week later from the CME on the 17th of December, so pretty much exactly a month ago now. And they had a little bit larger, perhaps institutional crowd in mind because they launched a 5-coin contract. And I'm sure that probably sounded good when they were first thinking up this contract, but 5 Bitcoins, particularly when they launched that contract, Bitcoin was right around its high, I believe, of nearly $20,000. That's a pretty meaty contract. So not surprisingly, the volume numbers have been on the SIBO side, but when you compare actual in terms of, multiply out with the multiplier, they've pretty much been pretty much equal in terms of activity out there. Of course, we saw the first settlement of one of those contracts just this week, and it seems to have gone off fairly smoothly, which I guess is a good thing. Everyone's asking us nonstop, when are we going to see options on that? I wish I had more data for you. I will say this, I did happen to have lunch with the folks at the SIBO earlier this week, this on Tuesday, and I asked their CEO this exact question. In fact, I said to them, I think I'm almost legally obligated to ask you this because everyone is asking me this question. When are we going to see options on these futures? And the response I got from him was effectively, they just had their first settlement. They want to have a few more settlements under their belt before they really launch options. And then B, they are in the middle of migrating their technology from the old SIBO platform to BATS, which of course they acquired last year. So that migration has to be done before they want to launch that as well. So I was always thinking around Q2. It seems like late Q2 will probably be the earliest something like this could be done. So for all of you out there who are hoping for Bitcoin options, not going to happen anytime soon. And Chris and Matt, how great would it have been to have options this week? Because pretty much it's been a bad start of the year. It's been a bad 2018 for all things crypto. I mean, this is just the numbers from Tuesday. I think they've rebounded a bit since then. But we pulled some of those numbers just from that one-day sell. I think they were calling it Black Tuesday in the crypto space. Bitcoin was off 20%, Litecoin off 19%. This is one day, listeners. Ethereum 22%, Bitcoin Cash 24%. And good old Ripple off 35% intraday. How nice would it have been, Matt or Chris, to have a nice juicy put? And granted, it would have been very juicy because I'm sure the puts would be crazy expensive out there. But how nice would it have been to be able to actually trade some options? I'm sure, Matt, you're probably getting this question a lot, probably almost as much as we are these days. Hey, can you do some back testing? What are your thoughts here on just, hey, we're in 2018. We have since we talked last, there are actual physical Bitcoin futures that you can trade now. And how excited are you for someday maybe having the prospect of an option on these things?
Yeah, I mean, as we talked about last month, I've been involved in investing in Bitcoin, for quite a few years. But the trader in me, curtailed a lot of the profits. You buy it at 100, of course you're going to sell it at 200. But I've been watching it very closely, and actually lately the volatility has come in quite a bit. Yes, it went down from 19,000. Where we were, we mentioned that we felt a little toppy last month, and we were right. And then, but it's I think the volatility has really come in quite a bit in Bitcoin and a lot of the related cryptocurrencies. So I think what we're going to start seeing is volatility coming in those, and yeah, we've been getting requests and it's obviously going to be very difficult to back test, but we have ways to simulate what the markets would have been at certain points historically based on certain points that we have had when you get actual markets. And I know that sounds a little bit confusing, but basically what we do for almost every market is we do our forecasts, and then what we're going to do is put out our what we think the markets would have been at certain points in the past, and adjust our forecast for what's actually happening when they finally do post some markets. But the way to go after and understand the crypto options is going to be trying to do as many simulations as you can and trying to get at as much data as you can, Mark.
Speaking of data in the crypto markets, I didn't realize this. Our folks over at Stock Twist sent us this, which is apparently, again, a limited sample set because these products haven't been around forever. But they kind of made an interesting point that beginning of the year, particularly January, has kind of always been a rough period for Bitcoin. It kind of always has a decent sell-off, apparently, in January. They sent over some graphs from 2015, 2016, and 2017, and now 2018. So, again, a limited sample set, only a few years, but apparently this time of year, maybe not the best for cryptos in general across the board. Chris, any thoughts for you? I'm sure people have probably been bombarding you guys at Swan of late saying, hey, when are we going to see the DRS on all things Bitcoin? So are you guys working on that right now?
Yeah, well, if there's certainly a demand, we're going to start working on it so we can apply our strategy as versatile as it is to many different underlyings. So, we're sitting back, we're watching it, and we're seeing if there's a need need for this down the road. Going back to what you said earlier, I think listing options on Bitcoin is a great idea, but I also think listing options on everything is a great idea, right? Coming from an options background. So, even though, as Matt said, that overall volatility may be declining recently, I'm more curious about how the skew is going to look like. It's probably going to be somewhat V-shaped, V for victory, which you may have to term a new type of skew here on this show. As opposed to the normal smile, which you would see in a gold type product. So this is, I think it's going to be some new exciting stuff once the options do get listed on this product. And I think there's going to be a lot of opportunity trading that.
Yeah, it'll be fascinating for you guys. So I know you like in that DRS, you like to buy that approximately 2-year output. I can't imagine what a 2-year put on Bitcoin would cost. It's going to be you're going to have some work ahead of you, Chris, to pay for that on the income side. I think of course the options will be juicy, so maybe it'll be easier than we think. But yeah, a 2-year put on Bitcoin. That's going to be juicy. That said, speaking of juicy, really quickly, the other big news that's been breaking since the last time we really talked is we finally pretty much have a deal when it came to taxes over there on the Hill now. The proviso, of course, is that none of us here are tax attorneys, so we don't spend a lot of time on the tax nuances. But that said, the tax bill as it pertains to options, it seems like it's fairly inconsequential for the most part. There were some early versions that really seemed like they might have some drastic impact on the options world. For example, some early Senate versions of the tax plan would have treated things like stock options, if you have them for a retirement plan or an employee incentive plan, would have been treated as being exercised when they fully vest, which is crazy. So if you have options for a couple of years and maybe they vest after 3 years, and all of a sudden after 3 years they're vested, well, guess what? You're being taxed like you cash those in. That would have been pretty drastic for a lot of people out there who rely on those for a significant portion of their retirement income. Being hit with a pretty large tax bill. We saw some other ideas of with things we've seen a few times, like when you write a covered call, immediately treat that as if you sold the stock there and tax it. Thankfully, a lot of those early flavors were removed from the final bill, including that provision to tax ESOPs when they vest. So it seems like overall the current tax bill really doesn't have a lot of huge impact for options. I don't know, Chris or Matt, anything that leapt out to you guys, again, with the caveat that we are not tax attorneys or anything along those lines. But that said, anything leap out to you, or you guys have the same opinion? This pretty much was, after all the Sturm and Drang, kind of a bit of a meh when it comes to the options market.
Yeah, I have a thought, and it kind of points to what Chris said earlier, that, the options education has really, I think, paid off in this respect as well, because as you say, Mark, there were some pretty scary initial things in there for options, and they didn't make it out. So, I think that this speaks to, continuing to, do that education helps with the legislation. And so I think that the strength of the option industry kind of showed that, this big change that's happened really didn't affect the option market too negatively, Mark.
All right, we got more stories, but of course I want to get some of you guys onto the program as well. So without further ado, let's keep on rolling and open up our office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com. emailing us at questions@theoptionsinsider.com or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody, welcome to the office hours, the portion of the show where we answer your options questions. Going to kick things off, actually, with me turning the tables on you two guys and letting you guys answer a question that we put to our audience last week. This is your first time on the network here for 2018, so I thought I'd let you guys play along as well. You have the added benefit of seeing the wisdom of the crowd, so to speak, in terms of how our audience voted. We asked everybody last week, starting off the new year, a quick, simple question. 2017 was kind of a year where VIX went away for the better part of the year. Where do you think VIX will close at the end of 2018? We asked you guys to put on your crystal ball cap there. We gave you 4 kind of tranches to choose from, between 7.5 and effectively 10, between 10 and 12.5, between 12.5 and 15, roughly $14.99, and of course above 15. I'll give you guys some info. Our audience was actually pretty evenly split between 10 and 12.5, getting 35%, and just barely winning 36%, getting above 15. So our audience kind of has 2 viewpoints, kind of where we ended up the year, and then also some people saying, yeah, I think Vol's coming back. We're kicking up above 15. Maybe Chris, we'll start with you. You get to play first here. Put on your crystal ball hat. If you had to prognosticate, which you do because I'm asking you, where VIX will close at the end of 2018, what are you feeling for this year?
I'm going to go above 15. I think the second half could be a regime shift in volatility, like I mentioned earlier. I think the stock market is going to have a little rockier of a time on the second half once all this euphoria of new highs and FOMO, fear of missing out ends, and people get a better feeling for what all the new tax codes are actually doing to the company's bottom lines, et cetera, and with tax repatriation, and et cetera, et cetera. So I do think also the streak of this absolute low volatility level will be reaching all-time highs as far as the length and duration of how long we've been in this new regime. So I would definitely, at this point, if I was a betting man, right, or a hedging man, which I am, I would definitely say that I think we're going to see levels above 15. I'm not saying that we're going to see levels too higher than 20, but I think volatility will pick up a little more in the second half of the year.
Interesting. I won't reveal where I guessed mine yet. I'll let you guys guess. I don't want to color your viewpoints, of course. But Mr. Matt, same question for you. Which of these four regions do you fall in?
I'm in the. This is going to be funny because I'm going to be in the exact opposite. I'm going to be under 9.99, and I think a lot of the reasons why we've seen volatility low, lack of correlation between stocks, these pension funds still pumping a lot into the market, the fear of missing out. But I think a lot of it is just the world is getting better. I know it's kind of weird, if you listen to the news, but people are getting along better. There's an incredible amount of technology out there. More scientists alive now than have been in all of history. I think crypto's real. Blockchain, hash graphs, all that will start to make have some type of an effect. And so I think the market. I'm still bullish on the market, and I think that a bullish market's going to see a lower volatility.
Hey, so it sounds like we have a trade here, Matt.
Yeah, I was going to tell
you what. If
I
I win above 15, you're coming down to Puerto Rico and treating me out to dinner. And if you're correct, we'll meet somewhere in the middle, like Chicago, and I'll treat you for dinner. How's that sound?
How about we do it?
You're not going to make me go to Maine. Please
how about we both do it in Puerto Rico, but it's just who's buying.
All right, deal. So we've got something to look forward to.
I like the Chicago angle though, because then I can get in on this awesome free Gibson steak that Matt is offering everyone here, which has now been recorded for posterity. By the way, Chris, I was with you. I picked the above 15 tip. I was just thinking I think we're going to get a little bit more Rock'em Sock'em Robots by the end of this year, but we shall see. Our audience clearly divided. Our panel here clearly divided, which is always means we're in for perhaps an interesting year. Let's see. We got a whole bunch of questions here. Let's get this one here from L Penguin. I just like his handle. He says, I'm a new options trader. This kind of goes back to what we were talking about earlier in the show here. And I want to buy a leap call because it looks like the stock is going to go up in the next 12 months. But I don't want to commit yet. I also want to generate income while I hold that position. What are your thoughts on selling the call while I have the leap? This is exactly what we were talking about half an hour ago here. I hope you're listening, El Penguin. Also, this stock has an attractive dividend that I like to capture. Is this even possible? Interested in your thoughts, thanks. I was thinking about buying a deep in the money call for the leap, and then depending on where the stock is trading at the time, sell closer to the money. Well, this is exactly what we were referring to earlier, saying, talking about our strategies for IRAs. You can do this in regular accounts, of course, as well. This is, depending on what you want to call it. Some people call it synthetic covered call. Our friend Brian over there at Options Playbook Radio likes to call it the fig leaf. Call it what you will, but this is exactly that kind of diagonal spread, buying that long leap call. So usually, like we said before, 60 to 75 delta, depending on your time frame, how much you want to spend, that sort of thing. But somewhere in that delta range, and delta is important because you want to have that delta is going to show you how much actual movement of the underlying you're going to generate with that trade. And then, of course, turning around and writing the call, usually at the most monthly, weekly, if you can handle the actual act of doing it weekly, will probably pay off better in the long run in terms of harvesting that theta. But still, that works. Now, the wrinkle you throw in there, which is kind of interesting, I'd be curious to get your guys' thoughts on this as well. All this works great until you want to get a dividend. That's where this strategy kind of falls down a little bit because you don't have the stock. It's a stock replacement strategy. And as we know from listening to this show, if you own the options, you don't get the dividend. So now that becomes a little bit of a challenge. I'm sure, Matt, maybe we'll start with you because you probably have had to model this for probably a bunch of your clients, I'd imagine, over the years. What are your thoughts on A, the strategy in general, which you kind of touched on earlier in the show as well, and then B, the challenge of getting that dividend and how that maybe impacts the strategy over time?
Yeah, I mean, the great thing about options is you can, if you could say what your wants and needs and outlook are, then you can put together an option position around that. It's a little bit difficult to know. This is a general question, but let's just say that it's the volatility is somewhat high. Well, it probably isn't that high, but versus the realized. To get the dividend, an easier way probably to get the dividend is to be long the stock, and then you could do an option around it. It sounds like this person's not totally set on the stock going up, so you can, perhaps collar the stock or something along those lines. But it's like I said, it's not quite enough information. But what I would do is test this out in a back test and show the person kind of how it looked over the time frame and try to get a little bit more information from them on the stock and what they think the volatility is. Mark?
Yeah, Chris, that's kind of where this strategy has a challenge is, of course, he wants to kind of have his cake and eat it too. He wants to have all the benefits of having the options and generating the income, but he also wants to capture the dividend. So now it becomes a bit of a dance. As Matt mentioned, you kind of need the stock for that. So you want to just do the stock and maybe not do the stock replacement, or maybe you want to switch around the time of when the dividend's coming around. But then, of course, there's going to be transaction costs involved there, and is it worth the hassle and the expense to try to capture how much of a dividend are they actually paying? There's a lot of things to go into this, but maybe in general, your thoughts on this strategy, and then B, maybe when people want to get the dividend, how that impacts things.
Yeah, look, I think it's a great strategy. Again, we talked about stock replacement here and generating income on top of that. So as far as the dividend is concerned, you're obviously not going to collect that dividend if you don't have underlying, if you don't have stock. But I will say, remember how options are priced, right? They're priced off the forward rate. So the dividend is priced into that option. It is going to be priced into that leap call that you're purchasing. So if you have a dividend or the dividend increases, the price of that leap option is going to decrease, right? The forward rate actually decreases. So it becomes cheaper to buy. So you may not get that dividend, but you are going to effectively pay a cheaper price on that leap option vis-a-vis another leap option that has all the exact same inputs but would not have a dividend.
Good point. Of course, that pricing does reflect the dividend. So yeah, you're not getting a 1-for-1 there, but you're going to get some of that bang for your buck. So when you didn't give us any specifics on the stock or how much the dividend is or any of that kind of thing, so we can't really say for certain. But in general, that's something for you to consider. And that's you kind of pointed out the one time when that strategy doesn't fall down, but it stumbles a little bit. And that's when you have a really great, juicy dividend-paying stock, and maybe you want to collect that dividend. So it's worth it for you to do a little bit of extra effort, a little bit extra homework, how much that dividend is, how much you can expect, what that rate is looking like on that leap. Does that make it attractive enough for you to buy and to say, forget the dividend? Or perhaps you need to do a little bit of a dance when the dividend comes around, swapping into the stock and back and forth. And it's all sorts of challenges and all sorts of fun. That's what makes it fun. I'll leave us with this thought. I'll let you think on this one, Matt, as we wrap up the show here. We got sent this comment here by Trading Proverbs. This might be a hard one to backtest, but it'd be kind of fun. I guess he sent us a quote by Peter Lynch saying, more money has been lost trying to anticipate and protect from corrections than actually in them, which I thought was an interesting point. I guess if you added up all the money spent and out of the money puts and so on in SPY and S&P for decades, maybe he has a point to that. I don't know. We'll have to look into that. But an interesting thought as the music comes on. We're here. We have to wind up the show. Keep those questions coming. We love to hear from you guys. We respond to everybody, even if you don't get a chance to answer all of them on the show. Maybe we'll have to do another whole Q&A episode just because we have so many great topics to get to. We don't get a chance to get to all your questions on the show. So maybe a Q&A episode will be in the offing in sometime soon. But before we go, let's go back around the horn one last time. Of course, our friends at OIC, our buddy Eric is traveling hither and yon. He couldn't be here, so you want to check out all their good stuff, including some great data for you to arm yourselves when you're talking to your clients about options. Head on over to optionseducation.org. Click on the Advisors tab there on the far right corner of that homepage, I believe, the top right tab, and you can get all the data, all the access to all the studies, the Collar study, the Cerulli study, everything they do over there. That is so useful when you're talking options with your clients. And Chris, same question for you guys. I know you guys have a lot of great 10th box events and other things going on. What's cooking in the land of Swan that may interest our listening audience?
Yeah, so in addition to the 10th box seminars that we've been doing, the SIBO is going to be sponsoring an RIA forum in Dallas, Texas. That's going to be on February 6th. So we are going to be there discussing how investment advisors can incorporate options into their portfolios. That's going to take place at the Westin in downtown Dallas. And if you want any more information, you can go to the SIBO website and look under RIA forums. And
Matt, last but not least, sir, you guys are always cooking up cool stuff over there in the frozen north of New Hampshire. Well, that's where you are. I don't know where the rest of the team is. I'm sure you're probably scattered to the winds like us here at Options Insider. But what do you guys have coming down the pike that may interest us? And if our listeners want to learn more, where should they go? What should they do?
Yeah, you mentioned tail hedging and how expensive it is. It is expensive, but when coupled with a income producing strategy, there are some very good outcomes that you could get, and we're doing quite a bit of testing on that. We have some huge clients implementing our strategies, so we're helping design those with broker dealers and how to follow the stock and do a lot of things that we could test out. So we're extremely excited about. Our back tester continues to improve, pushed by these clients that want more and more sophisticated strategies. So that's what we've been up to. And you can go to orats.com or email me at matt@orats.com, Mark.
There you go, orats.com. That's ORATS.com to kick the tires and light the fires for yourself. And on behalf of myself and Matt and Chris and all of you out there, I want to thank everybody for downloading, streaming, subscribing, sending in questions, all the fun stuff that you guys do to support the show. And we'll see you next time for more of The Advisor's Option.
You've been listening to The Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Global Investments. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, Swan Defined Risk Mutual Funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.